Great, fantastic. I appreciate the opportunity to be here. I'm Scott Marchant. I happen to work for Western AgCredit. We do a lot of production agriculture financing. We get into some other types of financing. But that being said, I've been asked to talk about some of the financing challenges and maybe some solutions to those challenges as far as how to get capital for a project that you're doing or even just operating capital. Hopefully, everybody can see the screen that I'm sharing. It says that you can. Is that correct? So I think the best way sometimes to learn is to just use an example. And the example I have is if you have a project that you're working on. And under this scenario, let's say that you have a $100,000 project that you're working on. I don't know what it is, whether you're putting together a new kitchen or remodeling a kitchen or putting together some sort of a processing facility of some sort, and the project's going to cost you $100,000. And let's say you're looking at a grant, right, to fit it into what we're talking about here today. You're applying for a grant. You think the grant will give you $85,000, and there's costs associated with your project beyond what you think you get for a grant. Say maybe there's in this example there's $15,000, or to add to it, maybe you're looking at a grant, and it's my understanding that a lot of times on these grants you have to pay even the grant eligible costs and then you get reimbursed afterwards. And so you're left with the question of where do I come up with $100,000 of capital, even though you anticipate getting this grant and getting reimbursed the $85,000. Where do you get the $100,000 of capital to be able to go forward with this project? So obviously what we have here is a capital issue. We need to figure out where to get capital, and there's only so many sources of capital. Um, Cash obviously is everybody's favorite kind of capital. You could sell assets and turn it into cash, and then you could use cash, right? But ultimately, cash, retained savings or earnings is a big source of capital, a common source. Grants, obviously, these are the very best kind, right? You don't have to pay these grants back. Um, Loans is a source of capital. We're going to spend quite a bit of time talking about what loans are out there and how they work. And then also there's leases, and we'll talk a little bit about leases. I don't claim to be any kind of expert on leases. I can talk a little bit about what I've seen out there in my business history, but we as a company don't do a lot of leases, but it is an option um, to find a company that does leases. We'll talk about that in more detail. As far as loan products go, one of the main loan products that I've seen people use to bridge cash flow shortfalls would be lines of credit or operating loans. I'm sure those of you that have started businesses before can relate with the fact that it always takes a lot of capital, even more than you generally think when you start up. You put together a business plan, you think you need X amount of capital, and what it usually ends up being is X plus. And so, what a lot of people will do that are a lot of people that are fortunate enough to be in the position to be able to get a line of credit will go to a lending institution and try and get a line of credit. And the way these lines of credit are set up are usually very, it depends on the financial strength of the applicant, right? So as a lender, when I'm looking at a line of credit, what I'm looking to see happen is if it's production agriculture, if you're producing peppers or tomatoes or anything in production agriculture, I would expect you to borrow on the operating line to plant, to water, to take care of, and then you harvest it, and then you bring the money back in to pay these lines of credit. And so over a cycle, an operating cycle, you'd see the line being drawn up and then paid back down to zero. And every industry is a little bit different on how they work, but basically that's the intent of a line of credit. The other thing that you could do is similar to a line of credit, which is a construction loan. I'm sure many of you are familiar with how construction loans, like if you've ever built a house before, you go out and get a construction loan, you build the house, and then you refinance that construction loan with a long-term loan. So you could also use a construction loan, which is somewhat similar to an operating loan. But the other option would be a credit card, intermediate term loans, long-term loans, and leases. So let's talk about the benefits, the pros and cons of each of these products. I talked a little bit about operating loans, kind of how they work. Let's talk about the benefits of them. They're very flexible, right? That's what people like about operating loans. You can borrow when you need, you can pay it back when you have funds available, and you're only charged interest on what's been drawn out. The benefit to an operating loan is the rates are usually significantly lower than credit cards. We'll talk about credit cards here in a minute. We all know how expensive they can be. Some of the negatives are they do have higher rates than a term loan, right? There's certain loan products that have the lowest rates. Operating loans are not those. It's very common for somebody to come to us and get a term equipment loan. Maybe they're buying a tractor, maybe they're buying some irrigation equipment, and we give them a rate, and then they come back and ask for an operating loan, and they're surprised that the operating loan rates are higher than those equipment term loans. And sometimes these operating loans are a little hard to get. My experience in banking, when we have a problem with defaults or a problem with loan losses, a lot of times it's in these operating loans. And so they are a little bit higher risk. They're generally secured by collateral that's a little more prone to evaporation, right? They're secured by accounts receivable, moving equipment, the crops, if it's a production agriculture type loan, those kind of things. So that's why the rates on those are a little higher. And like I say, they usually require collateral and generally involve annual fees. Every institution is different. Every bank's a little different on how they fee these. I've seen some operating loans that are set up for a 3-year period. And so you only have to renew them every 3 years. And so if there are fees, they're somewhat minimal because it's over a 3-year period. There's others that have to be renewed annually. And so it just depends on the institution and the strength of the applicant on those. Credit cards, I think everybody's familiar with credit cards. I know a lot of people use these sometimes, especially on smaller operations, smaller outfits. They're very flexible. That's the nice thing about credit cards. They, like an operating loan, they only charge interest on what's drawn. Sometimes I've actually seen this, and maybe we have some people like this on the call who they'll have several credit cards and they'll know exactly when the payment is due and what the cycle is of the credit card. And so they'll put an expense on a credit card so they can take full advantage of the 30 days without interest. So that is one benefit with a credit card. If you really only need money to bridge a gap for a short period of time, sometimes they can help you out. They're relatively easy to qualify for. I'm sure you're all familiar with that. And they're really they're unsecured. So that's a nice part. The negative, I'm sure nobody's going to be surprised when we talk about the negative parts of a credit card. I looked this up this morning. The average interest rate in America of credit cards is between 21 and 25%. So if you're not able to pay it off quickly, you do incur interest costs. They can be very significant. Also, I don't know if most people know this, but one of the factors that contributes to your credit score is your ratio of balance to available. And so if you have a tendency to have these credit cards and you always have them maxed out, it does impact your credit score. One of the things I think that the credit scores are looking for there is financial discipline, right? Do you have available credit that you don't use? So personal property loans. So these are more like your equipment loans, your car loans. Sometimes people will go do some improvements, or these are the loans that are usually between 3 and 7 years in term. Sometimes they can be a little longer. Sometimes they can go up to 10 years. I think I heard the other day that there are some banks that'll loan on cars up to 10 years. I don't know if it's a good idea or not, but I think it's an option. Like I mentioned earlier, they generally have better rates than other products. And quite frankly, vehicle loans, like a car loan, is one of the cheapest interest rate products out there, right? So if you're trying to do a project and your vehicles are paid off, you have equity in them, you could go get a vehicle loan and take advantage of those lower interest rates. The negatives to these are they're less flexible, right? They have a payment term. Generally they have a monthly payment that's due. If we're financing agricultural equipment, then we can set it up on an annual payment, but generally they have a monthly payment or some payment term. So they don't have a ton of flexibility. They generally require security. And so those are some of the drawbacks to those. Now, when I talk about long-term loans, I'm talking about loans that are greater than 10 years. For example, a home loan or a real estate loan, they're generally between 10 and 30 years. FSA does have a product where they do a 40-year loan, but honestly, the payment between a 40-year loan and a 30-year loan isn't that much difference because at that point, the vast majority of those early payments are all interest. So here's where you usually have your best rates. Some of the cheapest money you can ever borrow is on a home equity line of credit. I know there's a lot of people out there that don't want to borrow on their home. They don't want to mix their business with their personal, or they're afraid of losing their home. But if you're looking for just the lowest, best rates that provide also a lot of the flexibility that's available in an operating loan, these home equity lines of credit are a fabulous product for that. And then obviously the negative side is, you have to provide the real property security as I talked about. Leases, like I say, I don't claim to be an expert on leases, but I can talk about a little bit of what I've seen. At times, these leases can provide some tax benefits. They're taxed a lot different. You can show a lease expense as a business expense, the full lease expense, whereas if it's a loan payment, it's just the interest. Other than that, they're very similar to loans. Some of the uses where I've seen them used, where it made a lot of sense, is to finance specialized collateral. I've seen them used a lot in nurseries, greenhouses. I had a customer that used to use these leases to finance very specialized potting machinery. I've also seen them used in processing plants where they'll lease the equipment. And the benefit is the cost of the lease is similar to a loan, sometimes even higher. But the benefit is a lot of times these leasing companies will end up, you'll need less of a down payment to get the lease put in place and get the equipment delivered. So that's where I've seen them make sense, even though sometimes they're more expensive. People have gone that route because they just require less of a down payment. And the negative on them is it generally doesn't make sense. If you're looking for capital or some way just to bridge a short period, a lease really probably doesn't make sense, because when you put a lease in place, you make the first payment up front. And then if you go to them even a month later and say, okay, I want to pay off this lease, the payoff of that lease is most likely going to be the sum of the future payments that's in that contract. And so it's not like a loan where you pay it off early, you save interest. On a lease, you pay it off early, you end up paying off the exact same amount as you would otherwise. So that's talking about kind of loan products. I wanted to talk about being a banker. I wanted to talk about, what do banks care about? I've been in the banking industry for 24 years. I think I've worked with Western AgCredit the whole time, but I've done business with other banks. I don't know if you know this, but banks will buy and sell loans with each other in the back rooms. So I've dealt with other banks. I've run into other commercial banks. I think I have a general idea of what they care about. And basically they care about getting the money back plus a little, right? They want their interest. So just some thoughts I've put together here about considerations of things that you should consider when and if you're pursuing a loan. Repayment's a big one, right? They want their money back and they want the interest back. So they're focused on repayment. They're looking for evidence that you can repay the debt. We're looking for historical results, right? So quite often when you go into a bank, they're looking for tax returns, or they're looking for 5 years of profit and loss, or 2 years, or 3 years, or whatever they're asking for. So anything you can do to show historical results will help them get comfortable to say, I've been able to do it historically. That's why I can do it going forward. When historical results aren't available, clearly communicate both verbally and with a written business plan. And there's a lot of information on the internet about business plans, about how to put a business plan together. I'm sure there's lots of courses and lots of good advice out there that you can find. But what I would just add to that is when you're having discussions with a loan officer or a bank officer, communicate that, right? Don't assume that he knows, especially if there's no history. Communicate very clearly as to why you think it's going to work. And then additional considerations when pursuing a loan is it's a banking term. It's called secondary support, right? And what we see as secondary support is what happens if earnings aren't there? What if we put together this great projection that shows your ability to repay the loan, but it doesn't work? Then what? And so basically, we're just asking, how does the loan get repaid if the earnings fail to materialize as projected? And that includes, well, I have this other financial strength, or in a worst case scenario, this is how I would repay you. And then obviously, collateral, which is sometimes referred to as, the third level of support, that's how the bank ultimately gets repaid, is if earnings fail and I don't have another way to repay it, then the collateral repays the debt. And collateral is the easiest and quickest one to talk about. So really the one you need to focus on that most people don't is secondary support. How would you repay the debt before you get to the collateral step if earnings don't work out as expected or hoped? I think that's all I had. I don't know if there's any questions.
Yes, I have some questions. So we have a grant here that UDAF administers, and we've had it for a few years to purchase equipment to expand their processing capacity. And when is a good time to start the process of actually starting those conversations with a lender in anticipation of applying for that grant? Is it after you get the grant? Is it when you're applying for the grant? Is it before you start applying for the grant?
Yeah, it's a great question. Um, I think earlier is always better. Obviously, there's a certain amount of minimal information you need, right? It's you could go into a lending institution and you could say, "Hey, here's the project I'm looking at. I'm looking at getting a grant." And it's always helpful if you have the actual bid together, right? Is it $100,000 project or is it a $180,000 project, right?
Hmm.
There's no harm in stopping and talking to an officer and saying, I don't know if it's a $100,000 project yet or if it's 180, but here's my financial information. I'd like to get that all to you so you can review it and give me an inclination of how that looks. And then when I get my bids all together and I know exactly what the project is, and the next step would be I know whether I'm going to get my grant or not, right? Or maybe it's a deal you're going to do whether you get your grant or not, and the grant is viewed as the treat, right? The sweetener.
Hmm. Yeah.
But earlier is always better. I've never had anybody come into me and say, "Gosh, you came in too early," right? Come in, bring me your financial information, and let me review that. Even if you don't have your business plan all put together, give me your historical financial information. Bring me a balance sheet. Bring me your historical tax returns. That helps me to get an idea of what and who I'm dealing with.
Is there anything that they can do, like to not necessarily take out a loan and has, you know what I mean, but is part of that process to maybe get like a letter of, if this loan is, if this grant is successful, you know what I mean, then here's, you know what I mean, that you've already kind of worked out some,
Sure.
details in advance.
Sure. In the banking world, we call those term sheets. And basically, what a term sheet is it outlines the term of the loan that we're talking about or that has been applied for. And it says, we approve this loan under these terms, subject to these conditions, right? You could get a
Mhm.
letter that says, I approve this loan subject to the grant being approved, realizing that maybe later the funding for that grant would come in 30 days later.
Okay.
Mhm.
So they could actually, as part of the application process for, because I think there's been various programs that I've seen both at the federal level, the state level, you know what I mean, that have had different, conditions and stuff for some of that. And
Sure.
so, and some of them do say you need to have part of the process of applying is to show how you would be able to, kind of financially put this in place. So if they went into you in ahead of time, they had quotes on the equipment that they're thinking of getting or the improvements and stuff, looks at what's available, what's eligible potentially for the grant, what isn't, what are potential, you know what I mean, amounts that you would get from the grant, then you could work out, you know, kind of if this happens, then this could be the type of loan that and financing that we could use, and then you could generate a term sheet. Is that what I'm kind of hearing?
Absolutely.
Okay.
Yep,
And
absolutely.
and then that would alleviate the problem of that whole cash flow thing with the grant, but they wouldn't have actually taken out a loan until they knew that they were actually getting that grant.
Correct. Yep.
Okay.
You're absolutely. Yeah, the loan wouldn't be put in place
Okay.
until after that was known. Yep.
Perfect. And then what do you see in when businesses, not those early, sometimes we always talk about those early stages of getting started, which have their own financial burdens. But what are some of the financial burdens you've seen and some of the pitfalls businesses have run into as they, you know, kind of got established at what they're doing, but maybe some farms or ranches want to start doing some value added, you know what I mean, types of products or processing and stuff, and they want to start growing, either expanding into something new like that or just having a big expansion. What are some of the pitfalls that you see them run into with your experience?
Sure. You know, a lot of things come to mind, but I mean, timing is everything. And what I mean by that is you'll have sometimes somebody that expands in an industry just in time for the industry to go through a downturn. There's not always a lot you can do about that other than when you're putting your business plan together, just have that secondary look to say, okay, if it doesn't work out like I planned, then what are my options, right?
Okay.
And capital, right? Make sure you have capital because there's ups and downs. Things aren't going to go as you plan. And you don't know what you don't know. I don't know anybody that's expanded into a new industry that knew everything about that industry before they expanded into it, right? So not every personality is a risk manager. I'm a risk manager. I'm a banker. That's why I'm a banker, right? I will never, I don't have the mental capacity to be an entrepreneur. And I guess when you go into a talk to a banker, I mean, just assume you're talking to somebody who's a risk manager and trying to talk about risk management, right?
Okay.
It's not something that entrepreneurs are generally, it's not generally a strength, but
Mhm.
be willing to talk about if this doesn't work, then what?
Okay. And then along with that, sometimes the things that I've seen is maybe they are thinking about the actual physical improvement or the piece of equipment they need, but they're not thinking about we're not going to be able to immediately get money back from that. Or if they expand a lot, then they've got to buy a lot more supplies and pay for labor to get those products put together, and they might not get their money until later. And so, how do they kind of balance out not only the needs for the equipment, but then the cash needs for some of these other types of things?
Yeah, I would recommend you put together a monthly budget, right? Sometimes people, I think, skip some steps and they don't put together a monthly budget to know what their actual outlays are. Don't just go out and say, I need this cash right now. Look at a 1 year term and say, here's all the cash I'm going to need. I'm going to break it out by month. And then I'm going to measure my shortfalls and my surpluses down below to get an idea. And then, but but don't look at it and say, I just need enough. I mean, one of the things we look at as banks is we say a break even's not enough. I want to see a 30% margin over break even, right? And that's because we know in our experience that things don't always go as we expect. Sometimes they also on the upside, they go better than we expect, right? But that's
That's
not
right.
it's never those situations that cause problems, right?
And then one question was in the SBA loans, how do those factor in? I know that's not something that you probably deal with as much at Western AgCredit, but can you speak to those a little bit? The
Yeah,
pros
I
and cons
can.
of those?
Sure, I can a little bit. I have a lot more experience with FSA guarantees and FSA guaranteed subsidized loans. And generally, FSA and SBA are kind of doing the same thing. You can get direct loans from both, or you can get guarantees for both. The way the guarantees work is they provide the lender a guarantee, which incentivizes and encourages them to take more risk. So if I have an FSA guarantee, for example, they'll guarantee 90% of the loan, which limits my loss. If I lost 100% of my loan proceeds, FSA would step in and they would repay 90% of them. So they manage my risk And by managing my risk, I can give them a lower rate, and I'm also willing to take a little more risk. So,
What are some of
but
the bad parts of those, or what are some cons?
there's a fee for the customer side. There's a fee, but other than paying the fee and the time that it takes to go through the process and fill out the application, I don't know that there are any cons to the customer.
I think they're pretty good. It might be that they tie up and have a lien on more of your capital, so I
If
can't
they have a
remember what.
direct loan, if they have a direct loan, that's the case. But if it's just a guarantee,
Okay.
then that's not the case.
And then switching gears a little bit, is there a best practice when using a 401k or an IRA to fund a loan if you're over 59 and a half?
That's a great question. I'm the wrong guy to ask. um, I didn't think about that. See, I wanted to be able to ask everybody the ways to raise capital because I knew I didn't have them all on my list. And there's one that I've actually used before that I didn't get on my list. You can borrow against your 401k under certain circumstances. I don't claim to be an expert on that. Obviously, what I do understand is when you borrow on that. So if I were to go take a $50,000 loan out on my 401k, that those $50,000 are moved over here and they're no longer earning returns like the rest of my 401k are. So there, I've read several publications by experts. Some love them, some hate them.
And there
I,
can be some tax consequences of some of those things with those, and there can also be some penalties or other costs and stuff. So if you have a tax preparer, I would ask about them and just your normal communication, what that might do to your individual situation, because taxes are always nuanced to very individual situations, even though we have some general laws and rules. And
right.
then that'll give you kind of let you think through that. And then also with your lender, maybe balance that out against, some other options. Uh, that I think was a really good overview and just kind of got our feet wet. And it's always good to kind of talk about the financing, the numbers. And I think this is a nice time to just kind of see the different types of capital and way we can secure them. So I will turn it back over to Karen and she can start introducing the next speaker and we'll move on.
Thank you.
Thanks, Scott and Ruby. And just a reminder that evaluation is still up. If you haven't taken that yet, please do that quickly. I think it'll probably be up for another minute or so. And also a reminder to everyone to make sure that when you have questions, please use the Q&A function, not the chat, because sometimes it's easier to miss the questions that get put into the chat, but we're making sure that anything that's in that Q&A area that we will get that answered for you. So with that, I think we are ready to transition to the next presentation.